All right, let's go ahead and get started. Thanks everyone for joining. We are going to be talking about investing in emerging markets in 2024. So let's jump right into it. So this is actually a picture of the side of our current fund we have we're raising capital for. So gorgeous, gorgeous picture there. All right, quick disclaimer. So we are an investment firm and we are a capital raising firm. And so everything that we do does involve risk. And this presentation and this information is confidential. And it's for the sole purpose of your knowledge, but everything that we are providing is for educational purposes. We are not giving you any attorney's advice or CPA advice. If you need further advice, we of course always recommend reaching out to your preferred CPAs and attorneys. All right, meet the panel. So you've got myself. My name is Anthony Walker. I'm the Chief Investment Officer and co-owner here at Cornerstone Commercial Investments. And we've got John M. Sr. with us.
That's me. Hi, everyone.
Awesome. He's our CEO. And then we've got Sarah with us.
Hey guys, how's it going? Good to be here.
Awesome. Let's jump into it. All right, quickly, a little bit about us and show that, we have a little bit know what we're talking about here. So we were founded in 2017 with the purpose of acquiring and developing multifamily in tertiary and secondary markets across the Intermountain West and Northwest markets. We currently manage a portfolio of about 116 million with another about 50 plus million in development or under construction as we speak. We've currently raised about 53, we're probably about 55 million today. Over 50% of our investors have invested more than once with us, kind of showing our track record there. And given the chance, they're continuing to reinvest with us, which we love, we take as an honor. We've a targeted average return of about 15 to 22%. Of course, that's going to be weighed heavily on the hold period and the markets and the interest rates is determined there. And we've currently invested about 12 to $13 million in op zones, and we currently have an op zone available as we speak. All right, Sarah's going to tell us a little bit about the emerging markets and kind of why, jump into why we choose some of them.
Yeah, so we get that question a lot from investors or people that are reaching out to us of why we're actually investing in tertiary markets, secondary markets, lesser known markets. A lot of the times you're hearing people investing in Arizona, Texas, Florida. They're in Phoenix, these big markets, and people wonder why we're investing in markets like Coeur d'Alene, Idaho, like Bend, Oregon, like Sandpoint, Idaho, and why we're there. And these are some of our main criteria, and the next slide will show that as well. But why we like the Pacific Northwest is they're a lot less saturated markets. So in those Sunbelt markets, you'll see, everybody and their mom is building there, and there's a huge influx of supply. Not a lot of geographical restrictions, so infinite land. There's in Phoenix specifically, there's miles and miles of vacant desert that someone can build another apartment home of 500, 1,000 units. And it's a lot harder to control supply there. So we like to be in markets where there's mountains, there's rivers, there's things that are actually geographically restricting it so it can only get so big. Thus, in the long term, if you're investing in these markets, as we talk about investing in emerging markets, as you're investing in these markets early, over time, as those markets again start to feel those geographical restrictions, you can't build anymore, and then that thus is building up your demand and creating a lot of value for the projects that you're actually building. I kind of already mentioned this, competition with institutional companies. You have big institutional builders or what are building those 500, 1,000 units in those big markets, less so in the Pacific Northwest. With that comes that higher yield potential. We really like to be in areas with large rent versus own gaps, places where it's a lot more expensive to buy a home than it is to rent. It's significantly cheaper to rent and thus keeping apartments full, which we like, obviously, as apartment builders and owners. We like to diversify out of those primary markets. And then another big thing that we'll talk about a little bit later, but Pacific Northwest is known for those natural tenant amenities. It's something that I think is very unique to the Pacific Northwest, mountains, rivers, all those geographical restrictions also comes with a lot of geographical fun, as we like to say. It's, you can boat, you can ski, you can do all those things, that can be harder to do in some of those other, hot climates where there's maybe a little bit less of that. And, the last thing that's a little bit lesser known actually is the disaster zones. So you might have seen in a lot of those Sunbelt markets, insurance costs are way higher because you have things like earthquakes. You'll remember the big floods that happened in Texas, hurricanes. All those things are happening in those Sunbelt markets, and up here we really don't have much of that at all. We don't have earthquakes. The only thing that maybe we have is fire, but we do a pretty good job up here, um, controlling that as well. But other than that, we really try to stay away from markets that have those high insurance costs and those natural disasters. So those are just some of the main points. Those are a little bit lesser known about the Pacific Northwest and emerging markets in general. And this is some of the things that we look for. I'm sure Senior in our next slide, you can kind of speak to a little bit of this stuff. And, you've been doing this a long time, as you know. For those that don't, John Senior's been doing this for 30 plus years. And a lot of this is criteria that he's found through his experience. I'd love for you to talk a little bit about that and share some of the things that you've seen over the years, what makes investing in these emerging markets, so crucial, and why you've stayed away from those primary markets.
Sure. Yeah. Thank you. So there's a couple things that we look for and are the primary drivers of why we're in the markets we're in. We'll take Bend, for instance, or Missoula, two very similar markets. They're, not the major metropolitan cities, like, Helena or Portland, per se. And what that creates is an opportunity of our criteria here. So our biggest one is the rent versus own gap, meaning that it costs so much more to own a home versus rent, right? And so with the median home price in Bend, for instance, being 800,000, you can still rent for 2,500 a month, where if your home price is 800, your payment's going to be $5,000 a month, $5,500 a month, easy. And so it's much less expensive to live in the same town and sometimes close to and in the same areas and enjoy the same outdoor amenities and lifestyle as it would be to own there. The median income typically is, the way we underwrite these is we underwrite to 80% of the metropolitan income level in the county. And so we don't try to chase the upper level rents and try to chase only the upper tier and income, because we know that our renter base is going to be primarily people that can't afford a home. And then also probably some retirees that have sold their home elsewhere. They put the money in the bank and they're living off that as a fixed income, with Social Security. And so we use those numbers to underwrite where we want to be as far as rents and overall feasibility. We always use a trusted local property manager in the areas that we're in. We think it's very important to have a local presence, so that if a tenant has a maintenance request, or if we have a vacancy we need to get filled, or let's say that there's an issue at the property that needs to be dealt with right away, we've got somebody locally to deal with it. Jobs are key, jobs drive housing. And so we always like to be in markets, Missoula for one, that has a very strong and growing employment base. And it's diversified. It's not just based on healthcare or government. There's a lot of private investment, a lot of private enterprise and growth coming in these areas. And with that drives your population growth. And they also typically have growth boundaries. A lot of these tertiary markets have boundaries that are natural, right? So you've got the national forest, you've got BLM, you've got a lot of things that restrict where the city growth can go. And so, if you use Bend, for instance, there's an urban growth boundary that's driven by the geographical restriction that surrounds Bend. And unless you find a piece of property that you can build in that area, it's going to be very difficult to try to duplicate and very, very unlike Sarah used Phoenix, for example. You go down to Phoenix, we were down there just a few months ago. There are new buildings going up right and left, and they're all apartments, right? And so the more supply that you see in a market, it's going to drive rents down, which is typically not what you want. We always want to make sure that there's a really good hospital in the area. This is very important. Healthcare is very important to people, especially retirees. And it's very difficult for a area to attract new residents if there isn't good healthcare. So in all our markets, you'll see a really good hospital system. In those markets, we always look for location, location, location. So, what is it near? Is it an easy drive to shopping? Is it an easy drive to schools, to recreation, maybe entertainment? Those are all things that tenants look for. And then as a result, that typically drives low vacancy. And we're seeing that across the board. Our whole portfolio, we're usually between 95 and 97% occupied, which is where we want to be. One of our secrets is in all of our markets, if you look at a map on our website of where we are, you'll see a Walmart within 2 miles. And that's a underwriting secret I learned in my banking career, and that is Walmart has the most sophisticated algorithm to predict future growth in the commercial real estate industry. And a lot of people don't realize that. So when Walmart decides to go into an area, they've done a lot of research, and they are very good at predicting future growth. And so if you look at where our buildings are, you'll typically see a Walmart very nearby. And that's on purpose. And so our new offering, Sandpoint, for instance, I think the Walmart is 1.5 miles. And our Missoula project we're building right now, it's across the street. So, those are drivers to predict future growth. If you can get near a super Walmart, even better. And so that's typically our criteria.
Yeah, now, Senior, I wanted to jump into kind of a little podcast format. You've invested in primary markets, and you've invested into secondary and tertiary markets, and you've also sold property and bought more property in tertiary markets over a 3-decade career. What's kind of been your experience and, kind of investment returns and overall, why do you choose tertiary markets today?
Tertiary markets, typically the markets I like to be in are markets where people want to live. They choose there for lifestyle. And technology today has allowed people to live a lot of times wherever they want. Bend is the #1 Zoom city in the country, meaning there's more remote workers in Bend than anywhere in the country. They're living in Bend because they want to, for lifestyle, for all of the things that area offers, right? The same thing is true for Missoula or here in Coeur d'Alene or Sandpoint.
Yeah.
And so you can live in a lot of different places now, and people go to these places to vacation. Like, what would it be like to live here? This is pretty awesome. And they understand that usually the cost of living is lower than where they came from. And if they can bring their employment with them or get similar employment, their standard of living is going to be pretty good. They're also looking at rents. If they come from a higher, more expensive area, like we get a lot of people here in Coeur d'Alene from Seattle, Tacoma, Vancouver, and rents over there are much higher than they are here. They come over here and they're like, wow, I can get a nicer apartment in a better location for less money, and I can work remote. Why wouldn't I do that?
Yeah. Now, you sold some property in primary markets and you've exchanged it into tertiary markets. How do you think your investment has returned compared to if you would have kept your deal down in California, or if you had you made the decision, how do you think your investment return would have been looked different? Meaning, like, which one do you think was better long term?
So long term, we have doubled our returns since doing that 6 years ago, and the reason for it is because tertiary markets are growing. They're where people want to live, and they choose to live in these areas for cost of living and lifestyle.
Mm.
And these bigger cities, people just say, you know what? I don't want to deal with all the things that you have to deal with in living in a big city. A lot of times you're dealing with, crime and schools deteriorating, and now we're seeing riots and homelessness. And families just don't want to live there. People don't want to raise their kids in that environment. So they come to safe places like this where that just doesn't exist here.
Right. So
What was
your
your
cash flow's more than doubled since you've moved your portfolio up here, and you're still appreciating at a similar or better level as well.
Way
So it's not
better.
like buying properties in the Midwest where you can buy a 10 cap and increase your cash flow, but see very little growth. You're saying here when you exchange up, you doubled your cash flow and you're still seeing that high appreciation you saw in other markets.
Absolutely. And I'm glad I'm out of those markets I was in because they've gone downhill. And it's really sad to see. And I'm really blessed to be able to get out of it when I did. We do have a building over in the Portland area, and I wish I didn't, but I do. It's performing well, but my rents today are the same as when I bought it in 2017.
Mm.
And that's not good. And the reason that that is the case is because of all the supply, and there isn't, no one wants to live there. And when I bought it, we didn't have the same situation we do now there in Portland. And so, rents are not higher than the day I bought it. I'm not vacant, but there are other challenges involved. And so as soon as I can get out of it, I'm going to.
Mhm.
So.
Were you gonna say something there, Sarah?
Yeah, I was just curious. He actually kind of answered it, but I was curious not to backtrack a little bit, but you were talking a little bit about the growth of remote work and how that's become a lot more popular. In your years, have you seen um that tenant demographic change a little bit as more and more of your tenants are becoming remote workers or maybe moving. A lot of times when you're applying to live in an apartment, you can show past living experiences, past employers, of where they're coming from. Have you seen an uptick in that of people coming from Florida, different markets, and up to your apartment buildings as an owner?
We have the luxury of seeing where people come from because we always check, we always call their previous landlord for a rent, referral, and make sure they paid on time and that they were a good tenant. And so we'll see, people come from bigger cities, obviously, a lot of folks from, like I said, the Western Washington. We'll see people come from Western Oregon, actually, and then also from areas that they take jobs here. One of the things is there's a lot of job growth here, and jobs drive housing, and so we're seeing people come from Utah, Nebraska, and Kansas, and Nevada and Arizona a lot of times to take jobs here because they're like, wow, this would be a great place to live. It pays well, and for instance. Missoula just opened a brand new Amazon distribution center, and that has created, I think last I heard, it was over 100 new jobs in the first hiring wave in the first phase. And those are incomes that you can support a family on and working at Amazon. And they just opened a new VA hospital there, which is gigantic because there's so many veterans there. Veterans love these areas because they're safe, and they know that they can raise their family in a safe environment, and not to have all the big city issues.
Hmm.
Mm. It's interesting. I was just meeting with a local property owner here, and he was telling me almost 30% of his residents that are renting his property, though almost 30% don't live there year round, meaning that they pay a year round lease and they also live in Arizona. So they choose to pay $2,000 a month instead of buying a house, and then they choose to spend X amount down in Arizona, and they spend 50% in Arizona and 50% up here, and that's a pretty good deal for a landlord.
Oh,
So
absolutely.
I think
We have
that's
a
a
lot
bigger
of that.
trend coming too.
We have a lot of that. We also have a lot of couples that they both work remote, and so they get a two-bedroom, and one works all day in one bedroom, one works all day in the other, and and it works great for them because then at the end of the day, they can, they don't put a demand on the traffic situation in the local area or anything. They're not driving or commuting anywhere to go to work.
Mm.
And that offers technology has changed the way the demographic, makes their money and the way they live. And it's being in an area where people want to live is the key.
Yeah, I love that. Well, let's jump into wage growth. So another reason that we choose, tertiary or some emerging markets is because of wage growth, right? So you want to see wage growth across the portfolio, but in a lot of tertiary markets, Missoula, we point out here particularly, right? The average household income is a little bit lower than the national household income, right? So it's more affordable, but also if you move there, you're making less. But as we have inflation, as we have these other pressures that are putting pressure on incomes, they rise at a faster level historically. Like last year in Montana, we saw a 7.4% annual wage growth, which that was significantly higher than our rent growth. I think rent barely even grew last year because of supply in different markets, or it grew by a point or two, and wages grew by 7%. So long term, historically, rents follow wage growth, and if wages are growing quicker, typically longer term, you have a catch-up period like we saw in 2021, 22. And additionally, with that, when wages go up, it's just good for real estate investors because they have a better chance of paying their rent and paying their rent on time. Anything to add there, Senior?
I think the summary in purple there might be a little misleading. I think that what we saw in Missoula was people live in the outskirts of the city limit, and if you look at a map of, like, for instance, the area between where our Mullen Crossing building is and the freeway and the airport, and all of that has been developed and none of that is in the city limits. And so I think that's a little bit, the decline in population is a little bit misleading. But I do think that with income going up, it creates an opportunity for employers to say, hey, we can still count on having a place to live for our employees, and we can pay them well. And multifamily housing is typically that solution. And so we can afford to pay them more because the cost of doing business in these tertiary markets is a lot lower.
Mm. And then another reason is rent growth. So as we mentioned, historically, rents in tertiary markets are more affordable than a San Francisco, a downtown Austin, Texas. All these primary markets, they're downtown, they're kind of core sections where you make your income. They're much, much higher rents. And so when tenants move from San Francisco, they move from LA, California, and they come up here, $1,600-$1,700 a month for a 2-bed, 2-bath is cheap to them. But for us, that's great rent, and which also gives us a higher chance for increasing those rents as well. And then in the other graph here, so you can see, due to interest rates, we've had rents have hardly increased, and we don't really expect them to increase for the next couple of years. But then again, we'll have a catch-up period when the supply in the market catches up to that demand. We're going to have that catch-up period, and we're going to see more rent growth. And additionally, as cities like San Francisco, LA get worse, we're going to continue to see that influx of people here. And the last 25 years, the market's grown by about 5.4%. And so we still underwrite everything at 3% with the idea that we could overperform for our investors.
For sure. Yeah.
I think that that graph there on the right is interesting. You can see in 2020, 2021 and tail end of 22. I think that's really telling. Obviously, there was a lot going on in our country at that time, and that shows, where people were moving, and it was to places like Bend, again, out of those cities, We mentioned it earlier, Bend is the number one city for remote work right now, and I think that that shows in those areas, especially in that 2020 part of this graph where people were able to work from home. Everyone was sent home. They moved to Bend, Oregon. They had that huge, influx of people there. I think, to your point, Anthony, yeah, I think all across the country, we're seeing a little bit of decline as, rents aren't necessarily skyrocketing. Everybody's wallets are hurting a little bit with interest rates, inflation, everything like that, but it'll continue to grow up over time. But I think what's really interesting there is, the United States market rent per unit, that yellow line there, and seeing Ben's market rate per unit, surpassing that, getting above that 12%, which I think is pretty awesome.
Right. And then you see in years, in 24, 25, 26, you have rent that's, well into the 4%, and we're projecting 3%. So, which is what Fannie Mae wants to see. So we're staying kind of to the standard metrics. But if we overperform from 3% to 4% rent growth, and we do that for multiple years, that's a significant increase on income and value to our investors.
Yeah, for sure.
Right. And I think also what's really great, and I think, the theme of our webinar tonight is just about emerging markets and identifying them early before they explode. And a market like Bend, you can see how it did explode, and how fortunate those apartment owners were that got in 16, 17, 18. They saw massive rent growth, but they also, and it's again, it's calmed down a little bit. They saw massive rent growth, but I think overall, saw massive appreciation and value added to their properties that changed over time. I think, getting in early in emerging markets, if you're able to identify before they explode, you can add a lot of appreciation and value to your asset, which is critical when it comes to a long-term investment strategy. I think that if you can be patient, you can get in early in some of these markets, knowing that there's a lot of upside. You just got to be patient and wait for it. I think that, getting into emerging markets, it's really a long-term play, but over time can really, really, appreciate your investment, which is really critical.
Right. And I'll add to your point there, Sarah. I mean, so part of our investment theory or a thesis is to get into these markets before a mass amount of liquidity enters there. And what we mean there is before, you have a BlackRock or a Carlyle Group, an Alliance, before they come in with their REITs and their institutional capital, and they compress cap rates, they put more demand there, they market more. So if we can be in before that, then we're going to see significantly more growth. For example, right now in the Coeur d'Alene, Spokane area, we have Alliance and Carlisle doing a development out by the airport. We have, family offices entering the market. As more and more of these big players enter the market, they will compress cap rates because they're okay with a smaller return, hence giving our investors who invest with us the last few years a much better return when we decide to exit those properties at higher rents and better rates.
Mm-hmm. And my last point on that, I guess, going off of what you were saying is, Sandpoint, for example, that's our current fund right now. We bought the land for that 3 years ago. If you remember that picture in the very beginning, that's the snapshot of that land. We bought that almost 3 years ago. And since there, they've seen quite a few big companies moving in there, setting up shop with their headquarters or expanding. Some like Kodiak Air has been growing a lot because they had a big French company come in and purchase them, and they're expanding. But the biggest one was Schweitzer Mountain. It's a little known gem up here to locals. That Schweitzer Mountain is a great ski resort. It's a great outdoors paradise. And since we purchased that land, Alterra Mountain Company, who owns Deer Valley, some of the big ski resorts that you may know, they ended up coming in and actually purchasing Schweitzer. They have plans to expand, grow the entire resort and make it a big place. And we're super fortunate to have bought that land 3 years ago, because that same land today, with the knowledge in the market, knowing that Alterra bought it, that whole place is going to blow up. That same land, if we were to purchase today, would be far more expensive than it was when we first bought it.
Yeah.
So that built-in equity already, just from us knowing that there was some growth potential there, I think, that just built-in value for us. And point being, if you can get in early in these emerging markets, I think that it's super key for the long-term play.
Right. And now it's the biggest ski resort in Idaho or Washington. So
Right.
they have another 1,000 acres to open up, another village that they're going to start building. They have a lot of expansion plans, and that's just one of the major businesses in Sandpoint.
Mhm.
All right, the other thing that we'll talk about is population growth. So we put out here actually the Sandpoint market because it's grown by 23.88%. And you have the number there of 10,820. Well, that's Sandpoint, right? Then Sandpoint right on this border is Pend Oreille, and then you have Dover, and then you have Kootenai. So Sandpoint is the small city surrounded by other cities. So the actual county's over 50,000 people, and it's growing very quickly. I mean, 5% in the last year. Again, almost 24% since 2020. And that's because of jobs coming there, quality of life, the ski resort growing. They're all pushing for that. And it's very similar in all the emerging markets that we invest into, right? There's jobs, there's people, there's quality of life. People want to live there. But when a market grows by 5%, even if that's only 500 or 600 people, the demand on housing is really great because those markets are only delivering, they're not like in Austin, Texas, that's delivering 40,000 units. They're delivering a few hundred units or maybe 1,000 units, but they're quickly being absorbed over the period, and then they're right back to an undersupplied market. Sandpoint, for example, they've been plagued with a 1 to 2% multifamily vacancy for about a decade or longer. And as soon as they build a property, there's a product delivered over the winter, and they're releasing 10 to 15 units a month through the slower time of leasing because there's just nowhere to live. People are, bunking up, and people are living at places. So these tertiary markets, because of their low supply environment, they breed a really good environment to deliver new product to those markets.
Mhm.
Anything you want to add there, Senior?
I think that, like Sarah mentioned, and you did, Altera coming in with plans. They're a major resort operator. They operate Big Sky and Deer Valley and Mammoth Mountain, all these big resorts, and with that they bring year-round jobs, year-round development, and if you think about could you have invested in Park City, Utah, or in Bozeman, Montana, at the base of the hill, when they started? Well, you'd be doing pretty well today, right? And fortunately, our Sandpoint project is literally at the base of the mountain. So that's one thing, a major recognition, major marketing. They're going to be a driver for people to come there. And that's just wintertime. It's also got a huge lake there. They're building a huge resort there, another resort just like on Lake Coeur d'Alene with a marina. And it's going to be pretty fantastic. So that's
Yeah.
what these small markets bring is opportunity for lifestyle to come to life in these new areas, which is pretty exciting.
And back to that one really quick, Sarah. So that bottom parcel, that bottom piece there, that's an article from 2021 when Coeur d'Alene, where our headquarters is, Cornerstone, is located, was the #1 hottest market in the entire country, right? So COVID happened, and people wanted quality of life. People wanted to live in this beautiful area. They wanted to work from home. They wanted to come and get jobs here, and that led to Coeur d'Alene booming, right? And Coeur d'Alene's only about 45 minutes to 50 minutes away from Sandpoint, where our current fund is open. And kind of Sandpoint's a more expensive offshoot almost of Coeur d'Alene, and it's becoming, kind of the resort destination.
For sure.
All right, another thing I want to hit on is lower cost of living for retirees. So a lot of retirees made their money in the city, made their money in New York, made their money in California. They have a house they've owned for 10 or 15 years, and they want to go to a place like I was just speaking of. They want to rent an apartment in Sandpoint, and then they want to also live in Arizona. So they want to kind of spread their money. They want to be snowbirds, but they also want the quality of life. They want the, 80, 90 degree perfect weather that, Northern Idaho offers. And so one of the reasons that we invest into these markets is for that exact reason. There's 10,000 people retiring a day. And then over and over again, they're choosing these markets. I mean, these are all livability, top 100 communities that we are invested into. So Spokane, Washington, technically, Coeur d'Alene is a sub-market of Spokane, and so is Sandpoint, the general area. And Spokane, again, Livability, top 100. Missoula, Montana, top 100. Nampa, Idaho, which is down in southern Idaho, just outside of Boise, top 100. They're all tertiary markets, all secondary markets, but they all have a high livability score because they're affordable, their groceries are more affordable than other places, and they have excellent quality of life.
Mhm.
Anything you want to add there, Senior?
Oh, I think you hit the nail on the head. I mean, the quality of life is key. And so, if you can sell your house in Southern California and take the money and put it in the bank, and you can live in a place where it costs a lot less and you're on a fixed income and you can put money in the bank and just rent. A lot of people are doing that. We're seeing it in our buildings there. And it's a great way to, have them enjoy their golden years without worrying about, the cost of a maintenance of a home, or, they can do things outside that doesn't cost them anything, right? And so those are some of the things that retirees look for. We see a lot of retirees on our bottom floor units, or elevator buildings, and they take advantage of those amenities. The crime's really low in these areas, and the cost of gas is low. I mean, a lot of things, insurance, all of that adds up.
Right.
So yeah.
Right, and speaking of our Sandpoint project, again, that is why we designed it to be an elevator service building, right? So we can
Right.
cater toward the overall market. We can have retirees in there who choose to live in Sandpoint and live in Arizona and pay for a year-round lease, right? They can live on 1, 2, 3, or fourth story and have the beautiful views of Schweitzer and Lake Pend Oreille. And that's a big reason we designed it that way, is because of retirees.
Mhm.
Exactly.
All right, then just another, big point I want to push about emerging markets is just quality of life. So, I mean, I don't know if any of you have been to San Francisco lately, but I was down at Union Square about a month ago. And when you're walking around and you don't feel safe going out to breakfast or just being in the city, the other people are feeling the exact same way. And so a lot of families are wanting to get out of there. They're wanting to raise their kids in safer, better areas, and they're choosing emerging markets. They're choosing the Montanas, the Idahos, the Utahs, the Wyomings, these smaller markets where it's cheaper, they can work remote, or they can find a job. Healthcare is booming in most of these tertiary markets. You can come up here and be a primary care provider. You can come up here and be a surgeon, but also you can make good money and have a much better, education for your kids, have incredible support, and have an incredible quality of life. I mean, these are pictures from Sandpoint where we are building our project. This is Schweitzer Mountain in the summer, right? Gorgeous, trees. You can go hike around the mountain and you can be, at your apartment in 18 minutes. Wake surfing. But quality of life is a big reason, as Senior kind of said, reason he got out of, some of the primary markets was to go to where people are moving, go to where people choose to live, and they're not forced to live just to make an income.
Exactly right.
All right, now just to touch as we kind of close off our webinar here, we do have a current open fund, as we may have mentioned a couple times during the webinar. Sarah's going to tell us a little bit about what we have going on there in Sandpoint.
Yeah, obviously we've touched on it a little bit. You'll see our rendering down there below. It kind of looks so realistic. It actually looks like it exists, but it doesn't. It's vacant land right now. It's a new construction. It'll be 4-story. It's gonna be 146 units. We're gonna do some community workspace on the bottom. Again, speaking to that growing popularity of remote work and building community. I think that that's something that we're seeing a lot less of in our country. Is just is less community and less people gathering, and that's still very much a thing up here in these markets. We've seen that people want to have community, want to gather, similar values of people that want to know each other, especially outdoor heavy areas. Recreate together. So we're gonna do a community workspace, coffee shop, gym, gonna be elevator serviced, especially for those retirees. We learned that over 30% of people moving to Sandpoint, Idaho are actually retirees looking to do that same thing that Anthony was talking about, have a great long-term rental in an apartment, stay there for the summers, enjoy enjoy the warmth, and then snowbird on down to, you know, the warmer Sunbelt markets as well. So we're super excited about this one. It's an opportunity zone fund. It's great for capital gains investors. So if you or anybody that you know is looking for some tax shelter there for your capital gains, I highly recommend reaching out to us. It's a great long-term generational wealth investment fund. As we talked about, you know, there's a lot of built-in equity at this land that was bought before Altera came in and announced their purchase of Schweitzer. So we're super excited about this project. We know it's going to be a great long-term generational wealth fund. That's it's also great for tax and estate planning as well. So we're really excited about this one. And here's just a little bit on some of our projected returns. You know, it's going to be a big $42.5 million build. So it's going to be a big offering. You can see some of the information there on our targeted IRRs and average cash on cash returns. It's a long-term 10+ year hold. That's to have us take advantage of that opportunity zone and some of the tax benefits that are there. It's new construction, and minimum investment is 100,000, and that's from accredited investors only. So Anthony, anything to add there?
No, that's pretty much sums it up. We're excited for this project. Something that we have part of our thesis is we want to create, you know, communities that have a sense of pride behind them. So we have the coffee shop, the co-working space. It's going to allow tenants to live there and also mingle downstairs, because it's been proven time and time again, if you know people in your building, your retention's higher, you have better rents, and you have an actual community where you live. And so that's what we're designing here. So we have, you know, beautiful units. The top floors are going to have views of Schweitzer, views of the lake. And then, you know, on the weekends, you can, you know, or during the week, you can work at your co-working space. You can hang out in the coffee shop. We'll have a pickleball court. We'll have, you know, covered carports. It's a long-term hold, and we're very excited to deliver this. We'll also have furnished units for traveling nurses, kind of partially pictured here. We've got like a brand new 30,000 square foot primary care medical facility that's just, you know, a couple hundred yards down from the building. So we'll be working with the owners of that, shooting for traveling nurses. You know, we're about 10 blocks to downtown. There's jobs within 5 minutes away. We're very excited for this project. We are excited to bring our investors in, and we're excited to deliver some incredible returns.
Yeah. Well, that's it.
Yeah, that sums it up. If you have any questions on that, reach out to myself or Sarah, and we'd be happy to answer anything. We can jump on a Zoom call, phone call, text, email, whatever you prefer. We are open for your questions and comments, and we'd love to have you invest in this project. We're sitting about 40% funded and on calls every day, looking for, you know, more commitments and more capital. We're excited to bring this one to life.
Yeah. Thanks everybody for joining us tonight, learning a little bit about emerging markets and why we choose them. So yeah, there's some of our contact info. Reach out to us anytime. I'm here to help you along the investment process. So Anthony's great for answering questions. I can help you along the investment process. Whatever you guys need, we're always here. So thanks so much.
Guys.
Thanks, everyone.